Welcome back, my students. It's your BFF Tutor here once again. Today is a very important lesson. A lesson ebaluleke kakhulu during our time together in this road to academic and just life success, man. So, as for today, we will be doing this important, vital, crucial topic called balance sheets. If you are a high school student, varsity student, college student, just as a person who may be interested in business, this is an important topic to understand. Okay, so balance sheets. As we are doing the balance sheets, as I'm mainly focusing on grade 11 and 12 work, but it applies for those in varsity as well in college. So, introduction to balance sheets. Let us rewind back. Let's rewind back to your earlier grades in high school or as a primary when you guys were being taught accounting equation. I'm pretty sure you guys remember accounting equation, right? Accounting equation was this thing here. A is equal to OE plus L. As you know, I always try to simplify my work without losing you guys. So basically what we will be doing is the accounting equation. It's going to be broad, more details. That is our balance sheet. The A, remember, is for assets. The OE is for owners' equity. And the L is for liabilities. Remember, our A, the total of A should be equal to the total of OE when combined with L. So if this is 5 and this is 3, this should be 8. Good work. Because A will always be or must always be equals to owner's equity plus liabilities. So this is what we are going to be talking about here at balance sheets. Okay. All right. Now, the first and probably the most important thing here is to know your structure, because if you do not know your structure, you'll not be able to do your balance sheet. So we always start with the structure. I mean, you can know all the adjustments, but if you do not know the structure cycle, so remember, A is equal to OE plus L. We start with our A. Our A is what? Is assets. So just to make it simple, assets are the things that we as a business own. Okay, let's just say yes. Assets are the things that we own. Okay, assets are differentiated between two, or there's two types of assets. We have our non-current assets. So we have our non-current assets. See this word, non-current. We all know what current is. Current is something that is happening now. Non-current is something that is not happening now. Just the English definition of it. So these will be the assets that we will be keeping for a long period of time. We have two assets or two types of assets that we will be keeping for a long period of time. The first one will be our fixed assets. Now you have to remember your note number 3. Fixed assets. We have 3 types of fixed assets. We have vehicles, we have equipment, and we have our land and buildings. So we're gonna be here in our balance sheet, just gonna write fixed assets. We're gonna put all the costs of all these 3 things that I just listed. Gonna put the cost of equipment, the costs of vehicles if you have, the cost of land and buildings. So gonna be saying all costs, and we will be subtracting all depreciation. So if there's accumulated depreciation, we'll be subtracting it. If there's depreciation for this year, we'll be subtracting it. Minus all depreciation of our non-current assets. So basically, we'll be looking for carrying value. Remember, carrying value is equal to cost minus accumulated depreciation. All right. That is all you need to know for your fixed assets. Of course, you need to remember our note number 3, the diminishing balance method, the straight line method, which is not the focus for here, which we will be covering in the next video. Then the second one is our financial assets, or we can just say fixed deposits. Fixed deposits is our financial assets. See, our two types of non-current assets, both of them are fixed. Fixed assets, which is vehicles, land and buildings, and equipment. Then we have fixed deposits. Now the question is, what is a fixed deposit? Fixed deposit is the amount or is the money that we invest in the bank because of what? Because we will be earning an interest income. So it doesn't make sense for us as a business if we have like 1 million, which we won't be using anytime soon, to just be laying there in our bank balance because it's not earning us any amount. So rather than keeping the money in our savings account, the business may decide to fixed deposits. So this is the opposite of loan. Remember, loan is when the bank is borrowing us money. Fixed deposits is when it's like we are lending the bank money. So fixed deposits is going to be here. So we are going to put the fixed deposits amount here, and we will be minusing maturing fixed deposits. If there's any fixed deposits that is maturing, we need to be subtracting it here, because when the fixed deposit matures and it goes to our bank account. So this one here will be subtracted here because it is no longer a non-current asset. It has matured, meaning it is now coming to us. This will be subtracted from here, and this is we are putting it in our cash and cash equivalents because it will be going to our bank. Okay, that is it for a fixed deposit. So this is what you need to know for your non-current assets. Imagine just this. Come on, guys. I'm sure all of us will be able to do this by the end of our time together, which is coming. All right. Then we have the second type of assets, which is our current assets. So we also have current assets. So these are the assets that will be needed or will be used in the current period. The current period is 0 to 12 months from now. Okay, we have 3 types of current assets. These are the assets that we will be using within the next 12 months. Which assets is with us and will be used fast, quick, is the things that we sell. What do we call the things that we sell? Inventory. Now, inventory is the things that we sell. What do we sell? We have trading stock. So here, so when you open your brackets, you put the amount for trading stock, and you add consumable stores on hand. Trading stock plus consumable stores on hand is giving us our inventory. The second type of current assets we have is our cash and cash equivalent. So it doesn't matter if you start with this or this, as long as you have all 3 equivalents. So cash and cash equivalent, as you can hear the word cash and cash equivalents. So what we have here is bank. If our bank account is positive, we'll be having our bank here. If it is positive savings account, we'll be having what we call petty cash, a small amount that we keep in the business. Petty cash for basic small needs in the business. It goes under our cash and cash equivalents. Then we also have cash flows, which is money that we also keep in our business, okay, for daily uses or daily usage. Then remember, before closing the brackets, remember we have fixed deposit that has matured. We're minusing it from here. It is now going straight to us, so we have to add it here with cash and cash equivalent. Fixed deposits maturing. Okay, so this is what we have under our cash and cash equivalents. Then we have the last one. What is the last? Current assets. Those are the people that owe us money. Trade and other receivables. So trade and other receivables are the people that owe us money. Those are the people that took stock from us on credits, or people that have not paid their accounts with us. I mean, it's the same thing. Trade and other receivables. Now, before I insert some of the things that enter here, firstly, where do we keep the amounts of people that owe us? In the debtors control account. So now we are going to be putting debtors control. We are going to be minusing. Remember, when we were doing income statement, there's something called provision for bad debts. I'm just going to write it like this. The new provision for bad debts will be subtracted here. Okay. Then there's 4 accounts I want us to talk about before I continue with this. 4 accounts: accrued expense, accrued income, prepaid expense, income received in advance, or deferred income. Income received in advance. So we have these 4 accounts, okay? And we have receivables. Receivables are the people that owe us money, that need to pay us. Money that is receivable, we still need to receive. Then we have payable. I'm just going to write it here. Payables. Payables are the amounts that we need to pay. They are still payable. We haven't paid for them yet. These 4 accounts, 2 go under payables, and the other 2 will go under receivables. Let us start with accrued expense. What is accrued expense? Maybe we can start with the word accrued. The word accrued basically means that it is something that needs to be done but has not been done yet. So when you see the word accrued, so if it says accrued expense, it means that it is an expense that we have not yet paid for, but we still need to pay for it. Where does this go? Is this something that we need to pay, or is this something that we need to receive? Yes, this is something that we need to pay. So our accrued expense will go under payables, because it is an expense that we have not yet paid for. Okay. Then accrued income. This is an income that we have not yet received. Where does it go? Is it payables or is it receivables? Accrued income. Income we have not yet received. Because remember, income, it's coming in. So this is going to be going under our receivables. Okay, so whenever you see that there's an income that we haven't yet received, that is a receivable. Then we have an expense, prepaid expense. As you can hear the word prepaid. This is an expense that we paid before it was due. So we paid early. Our year ended on the 28th of Feb, but we paid for something that was going to be due in March. Okay, so it is for the next financial year. Prepaid expense. So whenever we pay for something early, we always assume, we're not going to be taking back the money, but we always assume, or we always treat it as if those people that we have paid, they are going to be giving us back the money because we have paid them early. They do not need the payment now. They'll be recording it when its time has come. Let's just say it like this to keep it simple without me going any further. So prepaid expense, we paid early, then they are going to be giving us back the money because we paid early. So this will be going to our receivables. We still need to receive this because we paid early. Then we have income received in advance. This is when we have now received income before it was due. Now we are the ones that need to give them back their amount. So it's the opposite, as you can see. So we are the ones that need to give these guys back because they have paid us early. So this will be going under payables. I hope this is clear. Please make sure that you pause this video and take this down and finish all of this video. All of this information is important, guys, okay? So as we have now finished this, we can now start entering. So here we are going to be entering, we said, accrued income. Are going to be entering accrued income. And we are going to be entering what else? Prepaid expense. Okay. Then what we need to do is we are going to, as we add all of these, obviously this will have its total, this will have its total, and this will have its total. We add all three totals and we are going to be putting it here under current assets. Okay, we are done with assets. Remember, now you have your current assets, and then here you are going to be doing the same thing. You get your total for here, your fixed assets, and for here, your fixed deposits. After adding these two amounts, you will be getting your, I don't have space anymore, but you will be getting your answer here under non-current assets. Now you now have your non-current assets and you now have your current assets. You are going to be putting both these amounts here at the bottom. The bottom will be written total assets. That is the answer that is going to be here. Okay, non-current assets plus current assets will give us total assets. That is the first part of our introduction to balance sheets. Now the second part of your balance sheets, we're done with assets. The second part of our balance sheets, remember, A is equal to OA plus L. We are now done with this. Now we need to do this owner's equity. Now remember, we are doing grade 10, 11, and 12, mainly 11 and 12. Owner's equity. In our grade 11, owner is called a partner. So it's going to be partner's equity if you are doing grade 11. That's the change that will be there. Then your partner's equity as a grade 11 student, there's going to be current account and capital, which we will focus in the next video, or the video coming up next on our balance sheets for grade 11. But for now, let us focus on the grade 12 as well. But even if you are doing grade 11, you should be sticking here because most of the things are the same. Grade 11, we are doing companies and the owners are called shareholders. So we will be having shareholders equity. That is our owners equity. Now in our shareholders equity, we have two things here. Firstly, we have ordinary share capital. This is the amount that we have received from all the selling of our shares. Ordinary share capital. As you can see, capital. This is the amount that we received for selling our shares. Then we'll be having retained income. Retained income is the amount. Both these notes, we are going to be doing them separately, okay? But for now, just to know the structure and the basics of the balance sheets, we have retained income, which is the amounts that we have retained at the end of the year after paying for everything. Now, our retained income, as much as we are going to be focusing on, but I'm just going to write the structure here. We add balance at the beginning, of the retained income, we add net profits after tax minus the buyback of shares at the price above average. But I'll be focusing on this, don't worry, rest assured, before the exams kick in. We minus the buybacks at price above average. And then we minus dividends. Now remember, dividends, there's two types of dividends. We have interim and we have final dividends, which we'll be focusing on when as I was saying. So add this, minus this, and you'll be getting your answer for your retained income. Okay, that is it for shareholders' equity. Then we now have liabilities. We can just say liabilities are opposite of assets. You can say that. So it's going to be the same for liabilities. They are also grouped into two. We have non-current liabilities. Non-current liabilities, these are the liabilities that we are not expected to pay in this current period or within the next 12 months. Our non-current liability will be mainly loan for this level of accounting. We'll be putting the loan amount here, the balance that we now need to pay, minus current portion of loan. Now, current portion of loan is any loan amount that we will be paying back within the next 12 months after our year has finished. I'll repeat that one again. Current portion of loan is any loan amount that we will be paying back within the next 12 months. Remember, we are talking about non-current here. So if you are now needing to pay, or if you are now paying for this loan, it's no longer a non-current, but it will go under current liabilities. Okay, so you get your answer for here. The answer for here will be the same as your answer for here, because our non-current liabilities is just gonna be a loan mostly. Okay, then we have our current liabilities. So these are the liabilities that we will be paying back in the next or within the next 12 months. Firstly, we'll be having trade and other payables. So these are the amounts that we need to pay during this current period. So here, what do we call the people that we owe money to? Oh, creditors. Creditors are found in the creditors control. The amounts that we need to pay our creditors are found in the creditors control. We add that amount. Then remember our two accounts that we talked about there in the previous before we rubbed off the board. Okay, so we said, what do we have, Gombe? Please do remind me. Remember, we were having prepaid expense, accrued expense, and all of that. Here, what do we need to pay? The first one was accrued expense, an expense that we haven't yet paid for. Accrued expense. Accrued expense. Add it here. Then we also add, what do we add? What do we add in terms of our income? Is it prepaid? Is it income received in advance? Or is it accrued income? We are going to be adding income received in advance, because remember, we said if we receive something before it was due, we need to give them back. So we need to add income received in advance. Okay, now sometimes in your answer sheets there may not be enough space for what we are going to be writing next, but I'll show you what you need to do to face that problem. After adding all of this, you'll get your answer for here. Then we also have our bank overdraft. Sometimes in our bank balance, we owe the bank money, bank overdraft. If we have a bank overdraft, we put it here. We can say a bank overdraft, but if the bank is saying credits, that is a bank overdraft. Or if they just tell you bank overdraft. Bank overdraft. And then we have shareholders for dividends. Shareholders for dividends. Remember, we have two types of shares of dividends: interim dividends and final dividends. Interim dividends are paid out during the year. Final dividends are not paid out during the year, but they are declared at the end of the year. They are not paid at the end of the year, they are declared at the end of the year. So we haven't yet paid for final dividends. We only pay for them in the beginning of next financial year. Okay. So for now, we are still owing. So our final dividends are still owed. So we still owe the shareholders the amounts that we need to pay for the final dividends. So we call final dividends shareholders for dividends. So when you see this word, it just means final dividends. It is here under current liabilities because we have not yet paid for this in this year. We are only going to be paying for this at the beginning of next financial year. Final dividends, we put them here. Then there's this one here. There's a SARS income tax. I'm just going to write it here at the bottom because I need to show you something. SARS income tax. Now, as for SARS income tax, it can go under our assets, under current assets. And it can also go under our current liabilities. It just depends on who is owing who. Now, during the year, there's a provisional tax that a company pays. So we estimate how much tax we'll need to pay. Then maybe let's say we estimate that we will be owing 1 million at the end of the year. Then we pay for 1 million. We pay tax for 1 million. We were estimating the tax that we will need to pay. But when the year ends, we see that actually the tax for the year was 1.5 million. Now, what does this mean? This means that we have paid 1 million, but we needed to pay 1.5. So there's still tax amount that is owed, right? So we still owe the taxman 500,000. Is that a current asset or a current liability? Yes, it is a current liability. So when we have paid for less than what we were supposed to pay, that is a current liability. So if our provisional tax is lower than the tax that we were supposed to pay, which you may find in your income statement, or you may need to calculate using 30% or 28% or whatever percentage that you are given. Compare your provisional tax, which is usually given in your balances, your trial balance, etc. Okay? Now let's reverse the situation. Let's say we calculated at the beginning or during the year that we will be owing 2 million for your tax. And then we pay this 2 million during the year. That is a provisional tax. But when the year ends, we see that, oh no, actually we needed to pay 1.5. So we paid more than what was required. So what do we do in this case? Here, that is a current asset because now SARS or the taxman needs to pay us back the amount that we overpaid by. So that is a current asset. So if it's like this, we go to our current assets and we're just going to be opening SARS income tax. We say 2 million minus 1.5 million to get our current assets or the amount that SARS needs to pay us. But if SARS is owed, we didn't pay enough, you're just going to put it here, SARS income tax, do your workings here, and you get your final answer. So I'm not going to be putting this anywhere. But it can be here in our current liabilities or it can be in our current assets. Okay? Please note that. Now, for us, I'm just going to remove this. So when I remove this, it's going to be total equity plus liability. Okay? So it's gonna be like this. Now what you need to do is you add all your current liabilities, 1, 2, 3, depends on how many you have here. Add these amounts, you get the answer. Add the amount here, add the amount here. This plus this will give us our current liabilities. Then in non-current liabilities, obviously it's this loan here. We'll add this plus this, so it's gonna be this plus this. We can put them in our liabilities, but usually you don't need to do that. When I just have your current liabilities and your non-current liabilities, then add your shareholders equity. So your shareholders equity is going to be ordinary share capital, so it's this plus the retained income will give you the shareholders equity. Now that you have this, your current liabilities, your non-current liabilities, and your shareholders equity, this plus this plus this will give us our total equity plus liabilities. As you can see, the word total equity, so we'll be adding equity plus your liabilities. Liabilities, there's non-current and there's current. Remember, this answer here should be equal to our total assets. That is how you do your balance sheet. Of course, we'll be doing a lot of questions regarding your balance sheets, but if you know and understand this, a lot of things will become easier when you are practicing or you are doing or you are writing your balance sheets. You know how we do it here. It's your teacher, your tutor, your BFF, Mr. Gumede. All the best to you guys. Much love from me. You do what you do, and I'll be doing what I do best. I'm signing out.